Imagine walking into a room every single day where a brilliant, incredibly wealthy, but utterly manic partner named Mr. Market stands waiting for you, ready to offer to buy your share of a business or sell you more of his at a completely different price than yesterday. Sometimes, this partner is so deliriously optimistic that he sees gold in every shadow, offering to buy you out at a wildly inflated price. Other times, he is plunged into such agonizing despair that he is convinced the world is ending, ready to sell you his entire stake for pennies on the dollar. Most people think investing is about crunching spreadsheets and calculating complex financial ratios. But Warren Buffett realized something radically different decades ago. Your biggest enemy in the financial world is not the economy, inflation, or hidden corporate debt. It is that bipolar partner living inside your own brokerage account. Why do 99% of investors fail to match the compounding machine of the world's greatest wealth builders? The answer lies in a psychological trap so deeply buried in human nature that most people fall into it without even realizing they are stepping off a cliff. Think about how you would react if you owned a quarter of a local apartment building on your street. If the real estate market hits a rough patch, and your frantic neighbor runs over to your porch screaming that the building is completely worthless, do you immediately call a real estate agent and sell your property for a fraction of what it cost you yesterday? Of course not. You know the tenants are still paying rent every month. You know the roof is solid. You laugh off your neighbor's panic and go back inside to pour a cup of coffee. Yet the exact moment that very same apartment building is represented by a flashing green or red stock ticker on a glowing screen, all rational logic instantly evaporates. Emotional distance is replaced by absolute emotional contagion. The flashing red numbers trigger a primal alarm bell in your brain, whispering that you are losing, that you are vulnerable, that you need to escape before everything disappears. You let a manic stranger dictate your financial destiny. Buffett watched brilliant minds with elite degrees and sophisticated computer models walk right into this trap, time and time again, simply because they lacked the emotional armor to treat stock certificates like pieces of a real, physical business. This brings us to a quiet room in Omaha where the Oracle of Omaha sits sipping cherry cola, completely detached from the deafening noise of Wall Street. While television anchors scream about market crashes and impending recessions, Buffett is reading annual reports with the calm detachment of a monk. He doesn't have a computer terminal flashing real-time stock prices on his desk. He doesn't want one, because he knows that if you look at prices every minute, your brain will start treating the market like a casino rather than a repository of businesses. When Mr. Market shows up in a deep depression offering wonderful companies at bargain bin prices, most investors run away in terror. They catch the dread. They surrender to the collective panic. They sell at the absolute bottom because holding cash feels safer than holding uncertainty. But Buffett does the opposite. He views market panics not as a crisis but as an extraordinary clearance sale orchestrated by a frantic partner. The secret that ordinary investors miss is that volatility is not risk. Volatility is simply the price of admission for superior long-term returns. If you cannot stomach the sight of your portfolio dropping 30% during a market correction, you are mathematically disqualified from earning the rewards that patient ownership provides. Let us look deeper at why the human brain rebels so violently against this simple logic. For hundreds of thousands of years, our ancestors survived on the edge of survival, where hesitation meant death and joining the tribe meant safety. If everyone in your tribe started running away from a rustling bush, you did not stop to analyze whether it was a harmless rabbit or a starving predator. You ran with them. Survival depended on hyperreactivity and social conformity. In the modern financial ecosystem, those exact same survival instincts become a fatal liability. When the market surges on a speculative craze, your brain triggers a powerful wave of FOMO, the fear of missing out, telling you that if you do not buy right now, you will be left behind while everyone else gets rich. That is the exact moment when bubbles are born. People buy not because the underlying business is sound, but because the crowd is cheering. And when the music stops, the sudden silence triggers an equally violent stampede toward the exit. The tragedy of the average investor is that they spend their entire lives running after the crowd, buying at the peak of euphoria and selling at the depth of despair, completely blind to the fact that the system is expertly engineered to extract wealth from the impatient and hand it to the disciplined. To break free from this cycle, you have to understand how true economic moats operate beneath the surface of everyday commerce. Buffett does not look for companies that sell commodities, businesses where products are identical and customers choose solely based on who is selling the cheapest. In a commodity business, there is no pricing power. There is only a brutal, exhausting race to the bottom where profit margins bleed out. Instead, he looks for businesses that own a psychological monopoly, companies that have built an uncrossable moat around their customers' habits and loyalty. Think about a brand that you use every single day without even thinking about alternatives. Even if they raise their prices by 5% next month, you won't switch. Why? Because the trust, the convenience, and the emotional safety they provide are worth every penny. That is pricing power. That is a toll booth on human behavior. When a business possesses that kind of economic moat, inflation can rage, interest rates can fluctuate, and recessions can come and go, but cash keeps flowing into the fortress. Ordinary investors look at the stock price and worry about tomorrow's headlines. Master investors look at the moat and calculate what the business will look like in 20 years, regardless of what Mr. Market is screaming about today. Yet, recognizing a moat is only half the battle. The real test is managing your own ego. Most people invest to feel smart, to prove something to their peers, or to chase the intoxicating adrenaline rush of being right. They want action. They want to check their accounts, make adjustments, swap stocks, and feel like busy, productive captains of industry. But in the world of long-term compounding, activity is the enemy of achievement. Every time you buy or sell, you pay a tax to friction, commissions, and your own emotional blind spots. Buffett often compares investing to a lifetime baseball game where you don't have to swing at every pitch. You can stand at the plate, watch pitch after pitch fly past you at 90 miles an hour, ignore the crowd screaming at you to swing, and wait until the ball comes right down the middle, slow and fat. In real life, people swing at bad pitches constantly because they are terrified of looking inactive. They treat cash as dead money that needs to be deployed, rather than ammunition waiting for the right war. That restlessness is the silent killer of wealth. Consider the compounding math that terrifies the impatient human mind. Compounding is exponential, not linear. In the early years, the first decade or even 15 years, the progress looks painfully, insultingly slow. It feels like nothing is happening. You put in your hard-earned capital and year after year, the growth curve crawls along the bottom of the chart like a flat line. This is the valley of disappointment. This is where 99% of investors lose patience, abandon their strategy, and pivot to a new trend that promises faster riches. They do not realize that exponential growth is backloaded. For a very long time, the engine is building roots beneath the soil where nobody can see them. Then, almost imperceptibly at first, the curve bends upward. The acceleration becomes breathtaking. But you cannot reach the steep slope of the curve if you dig up your financial seeds every time you get bored. Buffett didn't accumulate his fortune because he found one miraculous stock in his 70s. He accumulated it because he started investing as a child and simply refused to interrupt the compounding process for over 80 years. Time is your greatest asset, but only if you have the emotional discipline to get out of its way. This brings us to the core realization that separates the wealthy from the perpetually stressed. Independence of thought is not just a nice personality trait, it is a strict survival requirement in finance. If you need validation from your friends, your coworkers, or financial commentators to feel confident about your investments, you are destined to follow them over the cliff. True financial freedom requires a profound, unshakable comfort with being misunderstood in the short term. It requires looking at an asset that everyone is mocking, recognizing its intrinsic value through cold, hard analysis, and stepping forward while the rest of the room backs away in fear. That is why physical and mental isolation from the noise is so powerful. When you stop listening to the daily chatter of the financial media, your mind clears. You stop reacting to weather patterns and start focusing on the climate. You realize that wealth is not about how much you display, but about how much freedom you quietly secure behind closed doors. As you step back and look at the entire landscape, the illusion starts to dissolve. Becoming wealthy is not about possessing some secret formula or elite insider information that ordinary people cannot access. It is about subtraction, not addition. It is about stripping away the noise, eliminating the frantic need for constant action, silencing your ego, and protecting your attention from the relentless machinery designed to trigger your anxieties. Wealth is the sleep you get at night because your portfolio is built on enduring principles rather than speculative adrenaline. It is the quiet confidence that comes from aligning your behavior with human nature rather than fighting against it. The next time you feel that familiar tightening in your chest as the market drops or as a new trend explodes around you, pause. Step away from the screen. Ask yourself whether your next move is driven by calm, independent analysis or by the panicked voice of Mr. Market whispering in your ear. Take a deep breath, let the hysteria fade into the background, and remember that the greatest financial advantage you will ever possess is the ability to sit completely still while time and patience do the heavy lifting. If this journey into the psychology of wealth opened your eyes, leave a comment with your biggest realization, hit the like button to support the channel, and subscribe right now to keep uncovering the hidden mechanics of human behavior and finance.